There's an equation in history that never missed once. Not in the 16th century, not in the 20th, not ever. It doesn't care about ideology, geography, or the promises of politicians. It simply measures 6 variables, and when those variables cross certain thresholds together, economic collapse stops being a question of if and becomes a question of when. Empires that seemed invincible, currencies that appeared eternal, systems that looked too big to fail, all followed the same mathematical pattern on their way down, stage by stage, crisis by crisis, almost like they were reading from the same script. And today, right now, those same variables are moving into dangerous territory once again. But let me be clear about what we mean by economic collapse. We're not talking about invasion, revolution, or some dramatic overnight event. We're talking about exhaustion, the kind where money still technically works, where the government still makes promises, where life continues, but underneath, the foundation is cracking. Production stalls, debt compounds, the currency slowly loses its grip, trust erodes, and the world quietly stops believing in your future. That's collapse in practice, the kind that unfolds over years or decades, the kind where people wake up one day and realise their country isn't what it used to be. And it's never coming back. Now, here's where it gets interesting. Every collapse follows a checklist, a set of conditions that light up one by one like warning indicators in a cockpit. And when enough of them turn red simultaneously, the system enters what we might call the zone of inevitability. Think of it like this. You can survive one engine failing, maybe even 2, but when all 6 systems start flashing critical at the same time, the mathematics of the situation leave very little room for miracles. So what are these 6 variables? First, productive capacity, the real ability of an economy to make things, to build things, to generate value through labour and capital and knowledge. Call this P. When P is high and growing, an economy has resilience. When P stagnates or declines, everything else becomes exponentially more fragile. Second, debt load, both the absolute level of debt relative to national output and the cost of servicing that debt relative to government revenue. Call this D debt isn't inherently destructive, but when it grows faster than production, when interest payments start consuming a quarter or a third of your budget, when rolling over obligations becomes the primary economic activity, you're no longer investing in the future, you're just buying time. Third, monetary expansion, the relationship between money supply growth and real economic output. Call this M-print money. Faster than you create real wealth and you get inflation, currency debasement, loss of purchasing power. It's the oldest trap in economic history, and it never stops working. Fourth, external dependence, reliance on imports for critical goods, energy, food, materials, technology, and the vulnerability of your trade balance to external shocks. Call this E. The more you depend on others for essentials, the more your sovereignty becomes theoretical. Fifth, social trust, the degree to which institutions command legitimacy, cooperation functions without excessive coercion, and society can execute collective action. Call this S. When trust is high, nations can endure hardship, adapt, reform. When trust collapses, even minor problems become unsolvable. Sixth, reserve power and reach, whether your currency is accepted globally, whether your financial system sets the rules, whether the world saves and trades in your money. Call this R reserve status is the ultimate multiplier because it lets you export inflation, attract capital automatically, and borrow in your own currency indefinitely until suddenly you can't. Now, combine these 6 variables into a single index, a collapse index. The formula looks something like this. As D increases, as M increases, as E increases, as P decreases, as S decreases, as R decreases, the collapse index C rises. And when C crosses a certain threshold, when too many variables are moving in the wrong direction at the same time, the system enters critical territory. We're not going to assign exact mathematical weights just yet, because the 3 historical cases we're about to examine will show you how the equation calibrates itself. The beauty of this framework is that it's been tested repeatedly across centuries and continents. 3 civilizations, 3 different contexts, same equation, same outcome. So here's the plan. We're going to walk through 3 case studies: the Spanish Empire in the 16th and 17th centuries, the British Empire from 1900 to 1970, and the Soviet Union from 1945 to 1991. Each case will show you how the 6 variables evolved and how the collapse index moved from safe to critical. And then, after we've calibrated the equation with history, we're going to apply it to the present day and see where we stand. Because if this equation never missed before, we should probably pay attention to what it's saying now. Before we discuss today, we need to see how the equation behaved when an empire seemed invincible, when wealth flowed like water, and when everyone assumed the good times would last forever. Let's start with Spain. In 1500, Spain was ascending. The conquest of the Americas delivered an unprecedented flood of silver and gold. The Spanish real became the de facto global currency, accepted from Manila to Amsterdam. Spain's reserve power, R, was extraordinarily high. The world wanted Spanish coin, which meant Spain could import anything: silks from Asia, grain from the Baltic, manufactured goods from the Netherlands and Italy. But here's the problem: that silver wasn't wealth, it was anesthesia. It masked the fact that Spain's productive capacity, P, was stagnating. The Spanish nobility considered commerce and manual labour beneath them. Craftsmanship, industry, innovation, these were left to foreigners or to Spain's minorities. Meanwhile, the empire was overextending. Wars in the Netherlands, wars in Italy, wars against the Ottomans, wars against France, all at the same time. Military expenditure consumed more and more of the crown's revenue, pushing debt, D, higher and higher. Spain borrowed constantly, often at crippling interest rates from Genoese and German bankers. To manage the gap between revenue and obligations, the Spanish crown repeatedly debased its coinage, mixing base metals into silver coins, effectively expanding the money supply, M, through metallurgical sleight of hand. Prices rose. Inflation ate into the purchasing power of wages and savings. Foreign creditors grew suspicious. The real, once coveted, started to be discounted. At the same time, external dependence, E, was increasing. Spain imported food because agriculture was underdeveloped. It imported manufactured goods because its workshops couldn't compete. The silver that poured into Seville flowed right back out to pay for imports and service debt. One Spanish arbitrista, an economic writer of the time, put it bluntly: the wealth enters through one door and exits through another, leaving nothing but dust behind. Social trust, S, began to fray. The best minds emigrated. Bureaucracy swelled with unproductive posts sold to raise cash. The urban poor multiplied. Religious orthodoxy tightened, stifling intellectual inquiry. The The expulsion of Jews and later the Moriscos stripped the economy of skilled labour and commercial networks. And as the 17th century wore on, Spain's military defeats piled up. Portugal broke away. The Netherlands gained independence. France overtook Spain as the dominant European power. The Spanish real lost its reserve status, R, as other currencies rose. By 1650, Spain was still large on the map, but its economy was hollow. Let's look at the equation. Productive capacity, P, falling. Debt load, D, rising relentlessly. Monetary expansion, M, chronic through debasement. External dependence, E, structural and worsening. Social trust, S, corroding under economic and political stress. Reserve power, R, fading as credibility collapsed. The collapse index, C, crossed the threshold. Spain didn't vanish, but it ceased to matter. It became a museum, grand in memory, irrelevant in practice. The equation had spoken. 3 centuries later, the world watched the same mathematics unfold, this time in English. The British Empire in 1900 was the most powerful state in human history. It controlled a quarter of the Earth's land and population. The pound sterling was the undisputed global reserve currency. London was the financial capital of the world. But the seeds of collapse were already planted, and 2 world wars would force them to bloom. Britain's challenge was overextension. A global empire requires a global military, global administration, global infrastructure. The cost was immense, pushing debt, D, steadily upward. After the First World War, Britain's national debt had exploded, and servicing it consumed a massive share of government revenue. The rational move would have been to devalue the pound, to ease the burden on the domestic economy. But Britain chose prestige over pragmatism. It returned to the gold standard at the pre-war parity, attempting to preserve the pound's reserve status, R, at any cost. That decision strangled the economy. Restoring the old parity required high interest rates, which crushed investment and employment. Productive capacity, P, stagnated. British manufacturing, already facing competition from Germany and the United States, lost ground. Unemployment soared. Strikes erupted. Social trust, S, frayed as workers, and government clashed over austerity. The economy was being sacrificed to maintain a monetary illusion. Then came the Second World War. Britain won, but at a catastrophic price. Debt D skyrocketed again. The empire, already expensive to maintain, became unsustainable. Over the next 2 decades, colony after colony gained independence. India, the jewel in the crown, left in 1947. Egypt, Kenya, Malaysia, one by one, they slipped away. Britain's reach, its global financial and political power, R, contracted rapidly. Meanwhile, productive capacity, P, continued to decline relative to competitors. Britain imported more than it exported. The trade balance deteriorated. External dependence, E, increased. The pound, under relentless pressure, was devalued again and again. By the 1970s, Britain was negotiating loans from the International Monetary Fund. The currency that had once denominated global trade was now regional at best. Reserve power, R, had evaporated. Look at the equation again. Productive capacity, P, down. Debt, D, way up. Monetary dynamics, M, swinging between defensive contractions and inflationary escapes. External dependence, E, rising as industry faded. Social trust, S, battered by austerity, strikes and political crisis. Reserve power, R, in free fall from global to marginal. The collapse index, C, hit critical. Britain didn't disappear, but it stopped being a superpower. It became a medium-sized economy with oversized memories. Formal power without a productive base is just a facade. The equation, once again, had delivered its verdict. If the pound lost the world over decades, the next example shows how fast collapse can happen when the productive base was never really there to begin with. The Soviet Union in 1945 looked like a colossus. It had defeated Nazi Germany. It controlled Eastern Europe. It possessed nuclear weapons. It presented itself as the future of humanity. But underneath the propaganda, the fundamentals were catastrophic. Start with overextension. The USSR maintained an enormous military, spending 15 to 20% of GDP on defence, far higher than any rival. It subsidised satellite states, funded proxy wars, and poured resources into a technological arms race it couldn't afford. Debt, D, both external and hidden internal obligations, mounted steadily. Productive capacity, P, was the Achilles heel. Soviet factories were inefficient, producing goods nobody wanted to buy. Agriculture was so dysfunctional that the USSR, despite vast farmland, imported grain. Technology lagged a generation or more behind the West. Central planning couldn't allocate resources effectively, couldn't innovate, couldn't adapt. The economy was stagnant by the 1970s, shrinking by the 1980s. Reserve power, R, was nearly non-existent. The ruble was worthless outside Soviet borders. Nobody saved in rubles. Trade had to be conducted in dollars, gold, or barter. The USSR was utterly dependent on commodity exports, especially oil and gas, to earn hard currency. External dependence, E, was extreme and asymmetric. The Soviets needed foreign currency to buy Western technology and even food, but they had little to offer except raw materials. Then came the shock. Oil prices, which had been high in the 1970s, collapsed in the mid-1980s. Revenue evaporated. Hard currency dried up. The government couldn't pay for imports, couldn't subsidise satellites, couldn't fund the military at previous levels. Monetary expansion, M, lost its anchor. Inflation began to accelerate. Shortages multiplied. Social trust, S, which had always been more coercion than consent, disintegrated. The Communist Party's legitimacy was built on economic progress and superpower status. When both vanished, so did obedience. The satellite states in Eastern Europe broke away in rapid succession in 1989. The republics within the USSR itself began demanding independence, and in December 1991, the Soviet Union simply dissolved. Reserve power, R, went to zero because the state itself ceased to exist. Check the equation one more time. Productive capacity, P, abysmal and declining. Debt, D, unmanageable. Monetary expansion, M, unmoored. External dependence, E, fatal. Social trust, S, collapsing. Reserve power, R, obliterated. The collapse index, C, didn't just cross the threshold, it spiked. The USSR went from superpower to non-existent in less than 1,000 days. When social cohesion and reserve power are both fragile, the mathematics doesn't just predict decline, it accelerates history. 3 civilizations, 3 centuries, 3 times, same equation, same result. Now comes the test that matters. Today, let's apply the collapse equation to the present and see what the variables are telling us. Start with productive capacity, P. The current picture is mixed. There's been significant deindustrialization over the past 50 years, with manufacturing offshored to lower-cost regions. Critical supply chains, semiconductors, pharmaceuticals, rare earth, elements, batteries, are concentrated in a handful of foreign countries. Reshoring and friendshoring initiatives are underway, but they're slow and incomplete. Productivity growth has decelerated. Infrastructure is aging. The question is whether the economy can still produce what it needs when it needs it, or whether it's become dangerously dependent on the continuation of globalized, just-in-time logistics. P is not collapsing, but it's not robust either. Next, debt load, D. This is where the alarm bells are loudest. Government debt as a percentage of GDP is at or near historical highs in many advanced economies. Interest payments as a share of revenue are rising rapidly as rates normalise from emergency lows. Deficits are structural, baked in regardless of the economic cycle. Entitlement obligations, pensions, healthcare are growing faster than the tax base. The trajectory is clear. Without significant fiscal reform, debt service will crowd out everything else. Defence, infrastructure, education, all will shrink as a share of spending because the debt must be paid first. D is elevated and rising. Monetary expansion, M, has been extraordinary. In response to the financial crisis and then the pandemic, central banks expanded balance sheets by trillions, increasing money supply far faster than real output. Inflation surged, then was partially suppressed through rate hikes, but the underlying dynamic remains unresolved. The dilemma is stark: tighten too much and risk recession, loosen too soon and risk currency credibility. M is in a danger zone, caught between inflation and stagnation. External dependence, E, is underappreciated. Despite being a large and diverse economy, there are critical vulnerabilities. Energy supplies, though more secure than in the past, remain sensitive to global shocks. Minerals essential for green technology and electronics are imported almost entirely. Pharmaceutical ingredients come overwhelmingly from abroad. Food supply is relatively secure, but fertilizer and agricultural inputs are globally traded. Any major disruption in shipping, trade, or geopolitical relations could trigger shortages and price spikes. E is moderate but exposed. Social trust, S, is deteriorating visibly. Confidence in institutions, government, media, science, business has fallen sharply. Political polarization has reached levels not seen in generations. The ability to build consensus, to execute long-term projects, to make sacrifices for collective goals is diminished. Infrastructure projects take decades instead of years. Reforms are blocked by veto players. Communities are fragmented. Coercion, surveillance, and mandates are increasingly necessary to achieve compliance because voluntary cooperation has weakened. S is under severe stress. Finally, reserve power and reach are. This is the variable that has protected the system for so long. The dollar remains the dominant global reserve currency. The majority of international trade is denominated in dollars. Central banks hold dollars as reserves. US Treasury securities are the world's safe asset. This gives enormous advantages. The ability to borrow cheaply, to run trade deficits indefinitely, to export inflation, to sanction rivals by cutting them off from dollar systems. But R is not immutable. There are signs of erosion. Central banks are diversifying reserves, buying gold, holding more euros, yuan and yen. Bilateral trade agreements are bypassing the dollar. Alternative payment systems are being developed. Allies are increasingly hedging, reducing dependence on dollar infrastructure. The dominance remains, but the trajectory is concerning. R is high, but no longer unquestioned. So where does that leave the collapse index, C? Productive capacity, P, is weakened. Debt, D, is dangerously high. Monetary expansion, M, is unsustainable in both directions. External dependence, E, is real in critical areas. Social trust, S, is deteriorating. Reserve power, R, is dominant but beginning to erode. The collapse index is not yet in the red zone, but it's solidly in orange, the zone where margin for error is thin and where external shocks or policy mistakes can cascade quickly. History suggests that transitions from orange to red are often triggered by specific events. A loss of confidence in debt rollover, where bond markets suddenly demand much higher yields, locking the government into a fiscal death spiral. An external supply shock, a conflict that cuts off critical imports, driving inflation and economic disruption. A monetary credibility event, a moment where inflation expectations de-anchor and people rush out of the currency into real assets or foreign money. A social instability surge, widespread unrest that paralyzes governance and makes reform impossible. Any of these could be the catalyst that pushes the remaining variables past their thresholds simultaneously. But here's the crucial point. The equation is not destiny, it's a warning system. Every one of these variables can be addressed. Productive capacity can be rebuilt through targeted reindustrialization, investment in infrastructure, education, and technology, rebuilding supply chains for critical goods. Debt can be stabilized through credible fiscal rules, entitlement reform, and economic growth that expands the tax base faster than obligations grow. Monetary policy can be normalized transparently, restoring faith in the currency without crushing the real economy. External dependence can be reduced by developing domestic sources for strategic materials and diversifying supply chains geographically. Social trust can be rebuilt, though this is the hardest, through better governance, visible competence, fair enforcement of rules, and inclusive growth that doesn't leave entire regions or classes behind. And reserve power can be preserved through alliance management, maintaining deep and liquid capital markets, and avoiding the weaponization of currency systems in ways that accelerate de-dollarization. The path away from collapse is technically clear. Increase P through industrial policy, reduce D through fiscal discipline, normalize M with credible monetary frameworks, lower E through strategic redundancy, rebuild S through governance reform, protect R through smart diplomacy. If these things happen, the collapse index steps back from the edge. The equation resets. The cycle is broken. If they don't happen, if inertia prevails, if short-term politics overrides long-term mathematics, then history doesn't punish exceptionalism, it just repeats its patterns. The equation doesn't care about intentions, narratives, or promises. It only measures fundamentals. And when fundamentals cross critical thresholds together, collapse stops being a distant possibility and becomes a visible horizon. Spain had silver and assumed it would last forever. Britain had the pound and an empire and assumed its dominance was permanent. The Soviet Union had nuclear weapons and ideology and assumed it was the future. All three were wrong because all three ignored the equation. Their productive bases eroded, their debts compounded, their money degraded, their dependencies deepened, their societies fractured, and their power faded. The equation measured it all and predicted the outcome with perfect accuracy. Maybe this time is different. Maybe the current system will find a way to defy the historical pattern, but the equation doesn't grade on a curve, and it's never missed once. Right now, the variables are flashing warning lights. Not panic, not yet, but warning. The collapse index is rising. The margin for error is shrinking. The time to act is while there's still time to act. If we fix production, discipline money and debt, cut critical dependencies, rebuild trust, and protect reserve power, the index steps back from the edge. The gauges return to safe ranges. The system stabilizes. But if we wait, if we assume that size or history or exceptionalism will protect us from mathematics, then we're just another data point in the equation's perfect record. History doesn't punish, it just repeats, and the equation never misses.